The broadcast is now starting. All attendees are in listen-only mode.
Welcome, folks. I'm just doing a quick audio and video check. Okay, thank you, Rich. I'll wait just until the exact time and I'll start again. So I'll be silent for a little bit, but I'll come back in about 25 seconds. This is the right start. So welcome to the webinar. Thank you very much for attending. As I really appreciate, there's a lot of people today. So I'll try to be brief. We'll see how good I am at being brief and to the point. For those of you that don't know me, my name is Leo Valencia. I am your host at the Gamma Optimizer Room. It's a room inside the Elliott Wave Trader service dedicated to options, mainly to options in indexes like SPX, the S&P 500. And I am the option resident, host, that I'll design trades and I'll do volatility trading is pretty much what we do with SPX options. So the title of this webinar is Seasonal Volatility in SPX and how to take advantage of it. It's an interesting subject because we just are coming from a long summer of very low volatility in the market. And I'm trying to see what kind of opportunities we have into the last part of the year. Now we have 4 months to go basically on the year. The last quarter is going to start soon. So that's the whole point of this talk, to see what can we do. And I have already a question, a very interesting question, like what is Gamma? Thank you for the question. No, the service is called Gamma Optimizer. No, what is Gamma? So Gamma is a feature of options. So it's a concept related to options. That was my play on coming out with an interesting name for a service. So the Gamma Optimizer is actually a tool to optimize option trades. No, and Gamma is a concept intimately associated with options. So if you are interested, there are free classes in the service, and you can go over the videos, and there are plenty of explanations about Gamma. Okay, so I haven't started yet the presentation, and just still at the title. Okay, so let's start properly. Thank you for the question. So please let me know if you are seeing this slide, just in case the video is not updating. You should see on a slide. Okay, perfect. Okay, so I'm putting this seasonal chart. This is a seasonal chart of different values of intraday variance in the S&P 500 per month, from January to December, since 2008. I'm using 2008 because that's kind of the start of the new era in the S&P 500. So the S&P 500 is a complete different beast since the financial crisis. And as you can see, I have two lines there. Variance is measured in the same units that volatility is measured. I just use variance to differentiate from volatility a little bit, but it's the same concept. It's a percentage thing, and it's the same units than VIX, okay? So you can tell I have VIX in red, and you can see realized variance in blue, and they have more or less the same shape. And you notice that intraday realized variance in S&P 500 is very high in 2 months of the year. You can see the peaks, is in October and in March. And that's kind of a seasonal behavior of the market. It's a kind of a seasonal behavior of the market, and it is it's a behavior that could be exploited for profit. Now we could profit from this. And I'm receiving feedback that you are not seeing this page. I don't know what it is. Most of the people are seeing it, so I have no idea what is going on with you, George. I apologize. Maybe refresh the screen or join again. But now, if that you should be seeing a chart. Anyway, so notice this. Notice that during the summer months, during May and June and July, there is no volatility in the market. What is volatility? Volatility is a measure of dispersion. It's a measure of how much the market moves daily. And you notice that during these months, the market barely moves. It can go up and down, but very little. So realized variance on those months is very low. However, as the summer ends in July, and then August comes, and then September, and then October, notice the realized variance starts to go up massively before it starts again a cycle. And the same happened with VIX. VIX has some kind of mean values. You can see that VIX is mostly around the 20 most of the time for the last 12 years. But it exhibits a similar behavior. VIX tends to be really low over the summer periods, and then VIX starts to move higher and higher until October. Okay. This is predictable. If I can see it, anyone else can see it. I mean, this is not a secret of the market. I am not telling you something that is a revelation. No, all of the market participants, very sophisticated market participants, know this phenomenon. It's a well-known phenomenon, and we exploit it all the time. And for the members of the Gamma Optimizer room, if you ask them, you know that's why I keep repeating that September we will see more volatility in September, and I can tell you with confidence that we are going to see even more volatility in October. Now, October is a very volatile month. So how to take advantage of the two things? We can take advantage of the rise of volatility into October, and then it is possible to take advantage of the decrease of volatility, decrease in volatility after October. The only problem with this year is that we are in an election year, so the elections throw a little wrench into this. So we'll cover elections towards the end of the presentation. So let's start a little bit with what can we do now. So and I have a chart of volatility of volatility. Volatility of volatility is how fast volatility changes, and you can see that it's almost the same shape. Even volatility of volatility exhibits a tremendous peak in October. So historically, October is a very volatile month. That's the conclusions for these two charts. And then we have to do something about it. Now, like, how can we exploit the extra volatility in the market into October? So a couple of explanations are due, and I got, in fact, a question that says, oh, what is implied volatility? What is this? Okay. So the first thing is, realized volatility is not directional. I want you to focus on this thing. Is the charts that I showed you are not telling us if the market is going to rise or the market is going to fall. You know, those charts don't tell us that information at all. The only thing, the only information that you see in the charts I presented is that the market is going to have higher daily moves. Okay. In other words, during the summer the market will have moved 5 points daily up or down, or 10 points up or down. But now the market is moving more points per day, and you have noticed it in the last few sessions. You notice that the market is starting to move 20 points, 30 points, 40 points per day. And as we move into October, you will notice that those moves will get higher and higher. We're going to get bigger moves. So even if you don't know exactly what volatility is, the key concept to understand is that high realized volatility means big market moves in any direction. Okay, volatility is not dependent on direction. And low realized volatility means small market moves. So right now we are in kind of a transition from low realized volatility into a period of high realized volatility, and which will get used to this transition, which will get used to more moves into October and November. Okay, so this is the disclaimer. Don't think just because volatility is high, the market is going down, or because volatility is low, the market is going up, which is kind of a very common assumption of all traders. No, in terms of realized volatility, that's not how it works. Realized volatility is just about the moves of the market without regards to the direction. And I got a question about this that's connected. Let me present this slide. Okay. Implied volatility, on the other hand, has a correlation with SPX duration. It's kind of strong. No, a strong correlation means that tends to happen? Higher values of VIX or volatility products are expected after SPX falls, and lower values of VIX are expected after SPX rises. No? In other words, implied volatility rises if SPX falls, and implied volatility collapses if SPX rises. So it's kind of an inverse relationship between the market and implied volatility, which is a completely different concept than realized. Implied volatility is just the prices of volatility instruments, no? The prices of VIX futures, the prices of options. Realized volatility is the actual moves of the market. You notice the difference between the two concepts. Realized volatility is how the market is moving. Implied volatility is the cost of volatility products, okay? So in this case, yes, the cost of volatility products has a correlation with the current market dynamics. And something that is very peculiar is notice that SPX leads the correlation, and it's not the other way around. Most people believe that because VIX is rising, that the market will fall, or because VIX is coming down, the market will rise. It's the opposite. VIX reacts to what the market is doing. And this connects to a question. The question is that VXX, which is another volatility product, is moving now in the same direction than the market. So it's kind of breaking this correlation. And that's perfectly normal. I mean, there is nothing to read about it because the correlation is strong, but it doesn't mean that it's a rule, it's a law that is being violated. And strong correlation means that most of the time, this is what happens. And we are now seeing one of those periods where it's not, the correlation is not working. The volatility products are doing their own thing, and they don't care about the market. And there are many reasons for that. And the main reason for that is the elections, okay? So for those of you that really pay attention to volatility products, and this is something that I made a point on the room, the Gamma Optimizer room, is that you should expect VIX and volatility products in general to start moving higher and higher, little by bit, as elections get closer, okay? So the elections are the overriding material right now here. The market could drop and fall, and VIX will not care. Volatility products are focused on the election right now, okay? So don't the correlation is broken because the election is coming. That's what it is. So don't read too much into what is going on with volatility products. Is my recommendation for those of you that are watching the market and VIX futures and VXX. Okay, so it seems that the voice, my sound is not coming correctly. I'm trying to see if it's probably internet issues. Okay, so how can we take advantage of the seasonal effects in volatility? Well, so we know that VIX and realized variance are going to tick higher. Now we know that towards October. No, so it will make sense that the obvious trade is to go long VIX futures. That's the obvious trade. Like, okay, so because we know that, like, come on, it's a no-brainer. Just let's go out and buy tons of VIX futures or buy call options on VIX. And I will say, yes, that will be the obvious trade, but it's too obvious. And in this year in particular, it's twice as obvious because we have the elections, no? So yes, everyone has the same idea. I am telling you, yeah, the idea is so good that everyone has the same idea and everyone is doing it right now. And you're seeing it. I mean, if you look at the VIX futures for October, you will notice they are incredibly expensive compared to the VIX futures that expire in September. And it's because everyone knows that volatility is higher in October. And then you have the elections, and so this is a trade that is already crowded and it's kind of too late to enter. But any other year, if you can do it before the summer or just in the middle of the summer, it's a good time to enter this kind of trade. Right now, it's too late, and it's an election year. I will not recommend doing this trade anymore. So okay, well, so the obvious trade is out of the way. So what else can we do? If we cannot do the obvious trade, what else can we do? So what we can do is we can play realized variance instead. So instead of playing implied volatility, which is the volatility products, betting that they will go up, let's bet on the market, okay? Let's play with SPX options instead. So it's a perfect trade. It's a great trade, but there is a little caveat, there is a little trick to this. Remember that options already in the price that you're paying for them contain expectations of future volatility. Okay, so because options already contain the expectations of the future, whatever we do with them is a relative value play. And what is a relative value play? A relative value play is not a play of the volatility will be 20% or the volatility will be 40. We are playing on the difference between the realized volatility that happened and the implied volatility that we are paying for. Okay, so any options trade is a relative value play. What we are betting is not that realized variance will go up. Sadly, we cannot bet on that. But what we are betting is that realized variance will be higher than the implied variance of the options. Notice that there is a slightly different trade than the one that we want. But that's what it is. You know, we are constrained on the terms of trades we can do. So we have to live with this. And it seems that sounds goes in and out. So whenever you see sounds going in and out, let me know. It could be bandwidth, it could be something. But it seems that my microphone is okay. I can see my levels and they seem okay, at least on my microphone. So it could be internet connections. But anyway, I'll try to go over a couple of times every concept. So playing realized variance with options is really nice. You know, it's doable, but it is a little harder because we are playing with the difference between what the market is going to do versus what people expected the market to do. Okay, the thing is, the people that expects the market to do, the people that sets the prices for the options are dealers, and the dealers are really good at pricing the options. No, they are very good at pricing them, so they are not going to lose money that easily. Okay, dealers are not going to lose money that easily, and they are not going to lose money on something that everyone can see. Okay, so in other words, expect options to be overpriced during this month. Expect to pay a lot of money for the options, and expect to fail on those trades most of the time because the options are already priced. So one way to minimize this advantage that dealers have is to close the positions before expiration. So if we do a trade with options during this time of the year, we'll never carry the trade until expiration, because at expiration is when we can see the difference between what happened versus what the dealers study will happen. So instead of giving that advantage to dealers, we close way before expiration, and that way we kick that risk premium to the next person that buy the options from us. So we kind of, the way to trade this is to open a position, let it get a little fat, close it. And then whoever bought the options from us is now stuck with the risk premium that dealers are putting into the options, okay? So that's kind of the high-level outline of how to trade this in terms of with options. But now let's go into the particulars. So because we are betting on we're doing a bet on realized variance, we need to do non-directional structures. Okay, we don't want to do a play that bets that the market goes up or a play that the market goes down. We need to play something that requires the market to move in any direction. That's what we want. So the typical structures that are available, for those of you that are familiar with options, there are many structures for non-directional trades. The most popular is the straddle. Okay, the straddle is basically buying a call and a put with the same expiration and the same strike. That's a straddle. You buy the same, you pick a strike and an expiration, and you buy the same one call and one put for that. And that position is a non-directional position. If the market goes up, the call makes money. The market goes down, the put makes money. No, it's kind of one of those easiest positions. No, and I guess it's the most common one that you will find on the internet. However, it's a terrible way to play this. It's probably the worst way to play it. The reason is that I mentioned that option dealers are already overpricing the options, and in this structure, you are buying one of each. You are buying one overpriced call and you are buying one overpriced put, and you are stuck with one overpriced straddle. Okay, so it's a very expensive trade. And this trade, in order to be profitable, the market has to move a lot. And if the market doesn't move, this trade will suffer massive time decay. Okay, so the first advice here is forget about the straddles. In fact, always forget about the straddles. The straddles are only good as a pedagogical point, as an educational point. They really don't work in real life for retail traders. They are a terrible place. The alternative to an straddle is called an strangle. We could do an strangle. And they are actually much better because the strangles are very similar to the straddles. You buy a call, you still buy one call and you still buy one put for the same expiration, but they have different strikes, okay? And you could go, in the case of the S&P 500, in the case of SPX, we could go like a call for 4,000 and a put for 3,000, no, something like that. And the strangle, of course, is going to be substantially cheaper than the straddle because those calls are and puts are way out of the money. And indeed, it could work. I mean, the strangle in SPX could work if you have one day with a very strong trend. I mean, if you magically, by chance, manage to do it just before one day that the market moves 100 points, then that strangle is going to light up. But it still is very capital inefficient, in particular with SPX options. The SPX options are very expensive products. And even if they are out of the money, they are going to be very expensive too. So the two more common strategies are kind of like no-nos right now with SPX. What can we do? So yes, the idea is to improve on this. The idea is to, the strangle is kind of conceptually the way to go, but is in terms of practicality, is not the way to implement. But the concept is a good concept. So how can we improve in that concept? So we improve in that concept with binary strangles. This is how we're going to play. And in fact, binary strangles are my favorite strategy. In general, for long or short, binary strangles, I love them. It's kind of one of those strategies that are is really versatile, and you can do lots of interesting things with that. So what is a binary strangle? So it's a strangle, but instead of using vanilla options, we use binary options. And here I introduce the word vanilla. No, and just to explain, vanilla just means normal options. so all of the options that you see quoted in TD Ameritrade or Interactive Brokers or Schwab, those are in fact vanilla options. And they are called vanilla because they are normal options. But for those of you that are new to the world, there are many, many types of options, and there are really exotic options, which are the opposite of vanilla. And binary options are a type of exotic options. No, they are one kind of exotic option. So they are, I want to do the strangle with these binary options, okay? Instead of being vanilla, I want to do it with binary. One of the reasons I want to do it with binary options is, there are two reasons. One, they are substantially cheaper. Binary options are incredibly cheap compared with SPX options. SPX options are outrageously expensive. But binary options for SPX are substantially cheaper. And also, because the delta of a binary option is the equivalent to gamma of a vanilla option. In plain English means that a binary option gains in value substantially higher than a normal option for the same move. So if one day the SPX moves 20 points, a vanilla call, for instance, will make a few bucks. But a binary call is going to make tens of bucks, you see? So the binary call reacts substantially faster than the vanilla one. And there are lots of mathematical explanations why. And in fact, I think I have videos about this already, but I'm not going to go into the details. It's just in general, binary options are superior to vanilla options when we are playing this kind of long gamma strategies when we want to play the difference between realized variance versus implied variance. So yes, okay, so we are set. We are going to do binary strangles. So what is a binary strangle? We buy a binary call of a certain strike, and we buy a binary put of a certain strike, and that's it. It's the same that a normal strangle, just with binary options, okay, binary options. And for those of you that are really knowledgeable about the market, will know that they don't exist. Binary options don't exist in the USA. Sadly, since the early 2000s, binary options disappeared from the American market. Why? Because of course everyone was doing fraud with them. Like people were losing money to fraudulent operations. Most of the binary options dealers, quote unquote, were from like Cyprus or Russia or countries where it was very hard to recover the money from. Okay, so of course the American government came down hard on this, and basically, for all practical purposes, binary options are banned in the US, and even though they might be available in the rest of the world, Americans are not allowed to trade them. And by Americans, I mean American persons, could be citizens or residents. No? Despite that, CBOE, which is the same exchange that offers SPX options, used to have binary options, but no one used them. So they just delisted them. The same with the New York Stock Exchange and ARCA. They had binary options for SPY. In fact, they still have them. I don't think anyone uses them. They are not that popular for some reason, even though to me they are superior to vanilla. So don't despair. I'm just giving you context for this, that there is no market for binary options. There are maybe two exchanges that are regulated. I think it's Oanda and Nanex, but they are just, there is no liquidity on those exchanges. So those are kind of the last two exchanges that offer binary options. But don't worry, we can always replicate them. We can always create our own binary options. The good thing about binary options, which are exotic options, is that they can be replicated with vertical spreads. And a vertical spread is a very common construction with vanilla options, and all of your brokers can execute vertical spreads. The only key to this replication is that the binary option is replicated only if the vertical spread is very tight. Okay, so a binary call can be replicated with a vertical call spread, and a binary put can be replicated with a vertical put spread. And when I mention tight, you notice that I use the word tight vertical. It means it has to be the minimum amount of width possible. So in the case of S&P 500 options, is 5 points. So that's it. So how does a binary strangle looks like then? It looks like a four-legged trade. It's a trade that is a combination of two verticals. There is a vertical call spread with a vertical put spread. And for those of you that are really, really, really into this, that trade actually looks exactly the same than an iron condor. That's basically the trade. The trade basically reduces to an iron condor. Okay. The only difference is that we are long this iron condor because we want the market to move. No, that's what we want. So how does it look like? So I have an example trade here. And of course, please, this is an example. It is not meant to be tradable. It's just to illustrate the point of how to do a non-directional trade that benefits from the market moving up or down. Okay. So this is the trade. This is an iron condor, which is the put spread is the 3,230 strikes and 3,235 for October 30 for the end of October. So I want to capture volatility during October. So I'm going to capture a kind of like a decent fall and a decent rise. Okay. So those are the strikes for this. The whole position, in fact, is an iron condor. It is not done as two separate trades. And this iron condor in particular costs $2 per contract, which is okay. I mean, it's $200, and it can make a maximum of 300, which is 500 is the maximum payout, but we pay 200, so we have 300 net profit on this. But remember, we don't want to wait until the last day of October for this trade because option dealers are going to take us to the cleaners. So this is one of those trades that if we want to do this trade, we want to keep it until it makes really good money. Okay. So in this case, I will say 50% or more is what we want. And if you notice on the chart is it shows the profit and loss for different time frames in days, like 0 days, 5 days, 10 days. Those are calendar days. Sorry about that. And you notice that the break-even range, the range where the position break-evens keeps getting wider and wider as time passes. Of course, if the market remains in this area, we are going to lose money. And you can see, like, the worst case scenario is the market doesn't move. The dotted line is where the market was when I created the simulation. Notice that we're losing money. We can lose a whole dollar on this position if we remain 30 days and the market doesn't move. No, that's the kind of worst case scenario. Anything that the market moves up and down, it might make money. It makes more money to the upside than the downside, but that's kind of a feature of SPX options. So this is one trade. Notice this trade. This trade could make 50% if the market moves towards the 3,600 area, or if the market falls towards the 3,100, 150 area. And all depends on how fast it happens. If it happens tomorrow, well, this trade makes money all over the place. Now, I mean, this trade starts making money to the upside right away, as you can see in the red line. And then it takes a little longer for it has to have higher moves to the upside for longer time frames. But this is kind of the structure. This is how a binary strangle looks like. And notice that is decently cheap. Decently is very cheap, and it does what we think it will do, which is it will make money if the market moves a lot. And given that October is so volatile, that's the whole idea. The whole idea is that the market is going to move a lot during October on any direction. Okay, so this trade is okay. I mean, it's not. I am not in love with this trade, but it's a good starting point. Oh, I have a question. How did you select the strikes? How did I select the strikes? There are many ways of selecting the strikes. In this case, as you selected the strikes, so the spread, the total cost of the strangle will be cheaper. That's what it is. I mean, I wanted something between $1 and $2. That's pretty much the strike selection. It has nothing to do with that I expect the market to be below 3,230 on the last day of October, or that I expect the market to be above 3,606 at the end of October. But of course, if you have a thesis like that, if you already have your own thesis that says, oh, I think the market is going to be higher than 3,600, yeah, that's one way to pick the strikes based on a thesis. In this case, I didn't. I have no preconception of where the market will be. I just wanted something that was $100, $200, something that cheap, that it was not that expensive, and that's how I picked the strikes. Remember that the width of the spreads is always 5, so I didn't have to do much to pick the the width. No, it's 5 because this is supposed to be a binary put, and this is supposed to be a binary call. So that's one way to do it. There are other ways to pick the strikes too, but this is just an example. And the idea of this kind of trade is to ride it as until it gets 50% to 100%. I have another question, which is actually really good. Is this recommended as set until profit, or could you potentially actively manage it? Like take profit and reset the strikes until October, or sell the spread external so these the strikes? That's a great question, Ryan. Yes, this trade can be approached in two ways. One is enter the trade and wait for the profit to come in. Like when you have a stop, the stop is basically a loss of $1 on the trade, so you lose half of what you invested. And the profit is again $1. So whenever those things happen, whenever you either make $1 or you lose $1, you close the position, you move on with life and do something else. Or as Ryan suggests, this could be done in a much more active manner. Okay, you stay the position, and if you profit, you open a new one, and you keep doing that until you are incredibly rich. No. But if you want to that kind of actively managed type of trade, then this particular structure with this expiration for the end of October is not the right way to do it. So this one for the end of October is meant to be more like a less actively managed trade, something that you set and then you take off. If you want to keep doing it, it's better to have expirations that are not that far away. That expiration is almost 45 days away. So if you want to have this and keep doing it, I will say 15 days ahead and just keep doing it. Okay, there is a section about fine-tuning this, and I can talk about this more. I have another question. what kind of effect does an increase or decrease of volatility have on the trade? Yes, so this trade is incredibly sensitive to implied volatility. Of course, it's a binary strangle. So implied volatility goes up, the trade goes in price because implied volatility goes up. And if implied volatility collapses, then the trade will fail. However, the good thing is, let me see if I can go back without disturbing much the presentation. The good thing is, notice what VIX is doing during these months. Notice that the main effect of VIX, which is the cost of implied volatility, is that it also goes up. So we have seasonal effects on implied volatility in our favor too. So options, so this trade is sensitive to implied volatility, but we are on the right side of the effect because implied volatility is going to rise also during October. So that's what we expect. I mean, and there are reasons why it's going to rise during October. So I don't expect the total effects to be that much. Okay. So that's the example. Of course, you notice that this trade has a main defect. The main defect of this trade is that the break-even area is too wide. No, notice how wide. Let's say for 30 days, the last day of the trade, the break-even area is just after 3,250 and after 3,550, which actually is not that bad. No? But I mean, that's kind of like, man, that's a long, the market really has to move for this thing to make money, no? If you are going to wait a whole month for this. So can we improve on this? And the answer is, well, yes, you could improve. For instance, one of the reasons the trade is inefficient in one sense is because we are taking a non-directional stance, no? That's one of the reasons. But if you have a strong thesis, if you really have a strong opinion of where the market is going to be, you can be better set by a binary put. You know, if I split this, so instead of going for the full iron condor, I just do the puts, the vertical put spread. This is what I get, and this is a massive thing. I mean, this thing is actually fantastic. You know, this trade only costs $1, which is $100. And notice how fast it goes up. I mean, it basically, the market just falls whatever, and this thing is already making money. No, so these binary puts are actually making tons of money right away, and even after 30 days, they don't lose that much money. They still have like $60 on this. I mean, this is a fantastic trade. I don't know how likely is that the market falls, but if that is just an expectation, this could be a great way to play in the fall in the market. Now, doing a directional trade to the downside. And again, the same thing is try not to hold this until expiration, okay? Because I know, yes, you're investing $100 and you're making 500, but no one will wait until that late. You know, the idea is to take profits around this area. Notice that this area is not that far. This area is 3,250. You're already making 100% on that trade. So this actually is a very good trade to the downside. And the same thing applies to the upside, which is a binary call. The binary call is different. Notice the binary call doesn't make money right away. The binary call is actually, you really have to have the market moving. Notice that the break-even point moves quite dramatically through the life of the trade, and that the loss is quite dramatic. So the binary call loses substantially more money, but it still is a great trade. But it has a better slope again. So you're sacrificing into the binary put is something that is, notice that it really makes money in a very small range, but it's kind of gentle slope. And the binary call has a wider area where the market has to go over, but it really has a big slope. So it's still fantastic trades, both of them. And again, never wait until expiration, just close it. Just take the money and run. And one of the reasons which connects with the question is, do you always close out both sides of the condor, puts and calls? Okay, so yes, anytime I enter a trade, to me the trade is a single entity. So even though underneath it looks like an iron condor with 4 legs and all that complexity, to me it's just a single thing. And if I am making money on that single thing, I close it. Or if I am losing money of the single thing, I close it. There is no point on leaving like bits and pieces. Makes no sense to leave bits and pieces of the trade lying around, because that's not what I did. You know, what I did was I a unique trade with a unique thesis, and it either works or not. No, so I never hold fractional things or partial iron condors or legs here and there. It makes no sense. So anyway, so look at the binary call. The binary call is a great play too, and delivers fantastic money. Okay, so now let's come to the fine tuning. You notice that in all these trades require SPX to move a lot in one direction, either up or down, but it requires a swift move. And you notice also that the longer it takes for the market to move, the less money you make, no? And in fact, if nothing happens, all of those trades lose money, all of the trades. But they are good. All of those trades were long gamma trades. The vertical call spread, the vertical put spread for October, and the iron condor. And that's kind of what it is with long gamma. Time is against us. We need the market to move, and we need the market to hold, to actually move swiftly. And the faster it does, the more money we make. Okay. How can we fine tune the strangle? And this connects with the question from Ryan before. How can we make this type of trade, non-directional trade, more efficient? Well, you notice that the break-even area was 2Y, as I mentioned, and the reason is 2Y is because I pick October 30, which is more than 30 days ahead. I encourage you to experiment looking for trades in a closer time frame, like 2 weeks ahead, and do the same thing that I do. Just pick strikes that will give you a binary strangle price into $1 and $2, because max gain is 5 no matter what. So do that, and with that you will have much better results. And in fact, you could keep doing this several times. You could do it like 2 or 3 trades instead of just a single trade. No, so that's something for you. It's like homework for you guys to do. And I'm going to pause here because I think I'm about to switch subjects. Yes. So if you have any more questions about my binary strangle as my favorite type of trade for October, that's kind of like the flavor into October. Okay, so you can ask questions at any time in any case, so you can interrupt me. Now let's look into elections. I mentioned that this year is an election year. Election years are always fun, no? They make November to be extremely volatile. And for this election in 2020 in particular, there is an aspect of the election that is important to be considered. Okay, I have a question from the previous one. In terms of the iron condor, are the strike prices usually unrealistic to be reached? Yes, Tom. So that's a good lesson, and something that I try to teach the Gamma Optimizer members. The strike prices, the strikes of the trade are in a way irrelevant, because we are not going to hold the trade until expiration, so we don't care if the market reaches the strikes or not. What we want is the dynamics of the trade to be favorable to us. What we want is the trade to make money if the market goes up and make money if the market goes down. So the strikes are kind of secondary consideration. They are kind of important in the sense that the choice of strikes affects the cost of the trade. No, that's kind of the only parameter. If we want the trade to be cheap, we need to move the strikes a little far out. If we want the trade expensive, then we move the strikes in. But at the end of the day, we don't care. I don't have an opinion on the strikes. I don't have an opinion. I don't know if the market is going to 3,600 or 3,200. You see my point? The only opinion I have is that the market is going to move. Okay. I already did. I have a question. Can you give a real example of a SPX binary call option? I did that. This is the example. This is the binary call, and this binary call is just basically this leg of the. I don't know if you can see my mouse here. Is the leg with the 3,600, 3,605 October 30, the last day of October. So I basically just split this in two so you could see the behavior of the binary put on its own and the behavior of the binary call on its own. Okay. So that's kind of how this thing works. And now let's go back to the contested election. In the contested election is a scenario where we don't know who the winner of the election will be, or it will take some time for us to figure out when the election will happen. Okay, so that's kind of the contested election. And the last time this happened was in November 7th, 2000. For those of you that are old enough to remember the election 20 years ago. And if you notice, the market actually dropped 8% from election night to the end of November. And we could use this as a parameter because volatility markets are actually pricing high odds of a contested election in this cycle. If you notice, if you look at the volatility markets, the odds that we will not know the winner the next day of the election are very high. So we could do a speculative play with a binary put or a vertical put spread. A binary put or vertical put spread for me is the same thing. That is 8% down on November 30. And I will present it here. With current prices, this is the put spread. The 3,120, 3,125 is around 1.1. Is incredibly cheap and will deliver 3.9 or $4 if the market goes down 8% or more. So the return is fantastic. It's almost 4 times return on risk, although it's very speculative. And we need to assume that all capital is at risk. This is what we have to assume. And I have a question, like for an 8% down play, will you use the gamma optimizer to select the strikes? Yes, that could be a good way. I just selected these strikes by hand, but you could do it with the gamma optimizer. And this ties with my last recommendation. The problem with this trade, with this contested election trade, is that I don't think that it's safe to front run it. I don't think we should try to enter the trade so soon. We should wait until election day. We really should wait until election day and do the trade that day, because the market could be at 3,700. Who knows? I mean, who knows where the market will be from here to November 3rd? No? So it's better to wait, and then that day we compute the 8%, we use the gamma optimizer, or we do this by hand, and we just bam, we enter and go for 4x. Okay? So that's kind of what I want. And I have a question from Lou. Will you be making any of these officially in the room? Yes. In the gamma optimizer room, we are going to do like the real trades. Those are example trades. The strikes are kind of here and there, but my plan is to actually enter official trades with the strikes chosen in a more quantitative manner. But for those of you that don't belong to the room, I just wanted to present kind of the general outline. But yes, we'll do this. Okay. So for the contested trade, for those of you that don't belong to the room, also please wait until election day and then compute 8% down and look for the strikes around that area. For the gamma optimizer room, I will do a trade that day. So be on the lookout for that, because I also agree that elections will be contested. So that's one way to trade it. I have a question. How about the straddle one night before the election? I mentioned that the straddle is too expensive. There is no point in playing the straddle. No, it's too expensive. They are going to kill us. It has to be played with these binary strangles, no, or with vertical put spreads or call spreads. It could be done, yes, it could be done, depending on how expensive it is. But don't go for the pure straddle, because it's going to be outrageously expensive. What kind of orders are they? Market, net, credit, debit? All of option orders. That's a great question. Every order that you do for options has to be a limit order. Never, ever do a market order for options, in particular for spreads. They will kill you. There are no markets for these things. You have to send a limit and to say how much you want to say. So it's a limit, and all of these orders are debit orders. In other words, the maximum risk of all these trades is what you pay for them. No, there is no other risk. There is no margin required, and you are only risking what you pay. So in this trade, you're only risking $1, $1.1. Another question from Ryan. Going back to binary strangles that are shorter than 30 days. So you are saying that because you are trading on an IV trend higher into October, you could trade in and out of these several times, potentially capturing pure implied changes and maybe realize if the market keeps it? Correct, Ryan. That's correct. My favorite trade will be to do multiple ones during October, because yes, I want to benefit from both, from realized variance and from the rise in implied volatility. So that's how it's going to work. How are you choosing limit? The price? Yeah, prices for options. And this is an interesting question that I see all the time. Prices for options are always midpoints. And this is, if you are being in the Gamma Optimizer room now, you are well trained to think like this. If you are not part of my room, great advice is when you do options in general and spreads in particular, forget about bid and ask. Never ever in your life look at bid and ask of options. Always configure your software, configure your trading software to display mid prices. That's the most important thing. Some software packages, we call them marks, others mid, but the midpoint is the most important value because that's kind of like very close to the fair price of the option. So of course, it's very hard to enter exactly a mid, but you could enter really near mid, like near. And this is what is called providing liquidity. When you trade options, you have to be a liquidity provider. Always be a liquidity provider. There are many advantages to it. First is you are entering into in between the bid and ask, so you're saving money. And second, some exchanges give you rebates for providing liquidity. So you might get a few cents here and there just because you're providing liquidity. So that's how I do these things. I have too many questions. So let me. So another question is about options on futures, such as ES or NQ to cover after hours. No, there is no. I mean, if that's your thing, if you really love futures, yes, go by all means doing futures. I utterly dislike futures for many reasons, and there is no liquidity at all in those options. So if you enter a position and you have a vertical call spread or put spread with futures options, and you try to do anything with it overnight, you're going to get killed because there is no liquidity. Who is going to be on the other side? How many market makers are operating at 3 in the morning on any given day? It is a joke. I mean, the whole 24/7 promise of trading is completely worthless if there is no liquidity to trade. SPX options, on the other hand, during regular trading hours are extremely liquid, and you will always have a market for them. I have another question. SPX was very flat today, went down in the second half of the day, and the realized variance was low. It is possible we could have a long gamma decrease the same way that long gamma increase were kept. Could you the passive income consistently flowing into the market, consistent and gradually flow out of the market? If I understand the question, yes. It is possible that we can have a very controlled sell-off of the market. If that's what you are referring to, yes, it is possible. Market can go up and down in a controlled way, and we have seen it before. We have seen very gentle sell-off and then range bound. Okay, so that was the trade for contested election. I have another trade because I am running out of time. I have 8 more minutes to present the last 2 trades. I have a trade which is based on capital gains rates. The market is extremely sensitive to capital gains. I mean, if you have not realized this, it's a very important concept that you have to know now. Capital gain rates move very infrequently. In fact, they tend to move once per election cycle, every 4 years or every 8 years. So if there is a perceived movement on capital gains, the market will react to them. Last time we saw this was in 2008. In 2008, there was a perception that capital gains will go up, and in fact they did. And because of that, the market fell 5% on the day after the election. 5%. By the end of November, it was down 10%. That's how sensitive the market is to capital gains. And it works on both ways. If the expectation is the capital gains will go up, the market falls dramatically. And in 2016, we saw the opposite. The expectation was the capital gains will come down and the market just basically took off in a rocket. No? So for those of you that really want this trade, I mean, but you know what I am implying here, of course, for those of you that can read between lines. I'm not talking about interest rates, about talking about the capital gains is the taxes. Now, remember, if you trade in the United States and you make money in capital markets, you have to pay capital gains. Right now, long-term capital gains have, let's say, an advantage rate. The rate is lower than ordinary income. So for the people that trade capital markets like stocks or options or things like that, most of the bulk of our money is taxed as capital gains. So if that tax rate changes, if there is a perception that is going to go higher, then the market is very sensitive to it. And there are reasons for that. The main reason is, for instance, let's imagine that there is a change of regime after the election and the new president proposes to raise capital gains. Therefore, any decent accountant will recommend their customers to liquidate portfolios right away. And the reason is you take all of your capital gains and take advantage of the current rate. Then next year or 30 days after you close your portfolio, you open it again to avoid watch sales rules. And then you enter into your portfolio again, and then you save money. You see, there is an arbitrage because you know the taxes are going up. So everyone has to take advantage of the window when taxes are still low. And that's why the sell-off occurs all the time, okay? That's one of the reasons. So anyway, the whole discussion about this is that if that's a case, and if that's a realistic case, I don't know how realistic that is, but if you think it's realistic, then you have to be prepared for a fall of 10% by the end of November this year. So how to play that 10%? The same thing, put a spread 10% down. It could be even cheaper than the one that I showed for the contested election. Even if the election is not contested, that is the 10%. And it's very similar. Okay, I have a few questions. How do we join your room? Oh, well, in the Elliott Wave service, you can join the Elliott Wave service, and my room has 14 days of free trial. You don't have to provide a credit card. You have 2 weeks free, and you can join us and see what we do there. And if you like it, you can stay. No, it's very simple. And I think in the email is the information was mailed. I don't know. I usually don't do these things by myself. I have Tom by my side doing this part. But let me type an answer. You just go to elliottwavetrader.net. I hope everyone sees it. I don't know if that will work if I type it correctly. Anyway, so that's kind of the other trade that is possible to happen. But this one is kind of 50-50. Will it happen? I don't know. The contested election is almost a given. That has very odds of happening. The capital gains rate is like a 50-50. It's like a coin toss. If one of the candidates wins, then so the guy that is not in power wins, the capital gains will go up. So that's how it works. So I will say that it's very right there. And of course, the last trade is the re-election trade. Okay, the re-election trade is nothing changes. Everything continues as business as usual. The elections were not contested, and the re-elections occur. In that case, what we have to expect is a massive collapse on volatility, massive, and perhaps a rally in SPX. I don't know about the rally, but it's in VIX. The thing is VIX. VIX will collapse massively. The only problem is that the trade will be really hard to pull off. It will be really hard to pull off on the implied volatility space because shorting VIX is really dangerous. But that will be the perfect trade. I mean, if you're convinced that this is the scenario, that's the trade. It's a no-brainer. VIX will collapse massively. If you don't want to short VIX, perhaps a binary call spread for the end of the year. I mean, the market could rally until the end of the year with outrageous targets. It's very similar to all the things I have shown. And in fact, we are running a variation of this trade on the Gamma Optimizer room. That's what I'm running. And those were all my trades. And let's go through all the hundreds of questions I already have. And I go over the questions really quickly. I have 2 questions. Can I get to review later on? Yes, there is going to be a recorded video of this presentation. You can see it. How can you contact me? Okay, you can write to me at this email. I'm going to type an email. I don't know if you will see, all of you will see this. This is my email in case you want to contact me. Okay. Okay, so if you have any other questions, please let me know. Otherwise, thank you very much for attending this short presentation. I took a little longer than I expected. I just wanted to give you an idea of the kind of trades you could do around elections and around October, which is clearly a very volatile month. And I hope you enjoy it. And I hope you come to the ElliotWaveTrader.net room and check the Gamma Optimizer service. And it's actually a really good community. In fact, a bunch of my members, I recognize a few were here. So you're welcome to come, man. Thank you again. Have a great afternoon.